All right, so today I wanted to make a quick video on a post that I made recently on Twitter, and it is one common trait of below average investors is constantly panicking over volatility, or I put it normal volatility, but either way you could put it. And this is something that, again, you see constantly with, I would say, people that either don't invest or invest, but their idea of investing is you give the bank your money and you let them do whatever. Not investing is a terrible idea. Investing, but just giving it to a fund manager or the bank and just picking some generic, aggressive, moderately aggressive, or safe investment. Like, the worst thing you can do is not invest. The next worst thing you can do is just blindly give someone your money. There is a lot of people out there that, I'll take a step back here. My personal opinion is most people should be managing their own money, for the main reason being that it really is not that hard. A lot of people, they'll ask me, what are you kind of investing? You stocks or bonds or ETFs or mutual funds, et cetera, et cetera. And I always say, well, a little bit of everything. No mutual funds, but a little bit of everything other than that. And people don't realize that you could do it yourself and just buy a handful of ETFs. And the point I'm trying to make there is most of the time when people have other people managing their money, they're not doing anything special. They are simply just taking a risk profile and investing based on that. If you're aggressive, we're going to do 80% stocks, 20% bonds. If you're mildly aggressive, it's going to be 60-40. If you're conservative, it'll be 40-60 or 30-70. Like, most of the time, they're doing something that is incredibly simple, that an amateur could do themselves. And they're charging, 100, 200, maybe even 300 basis points. And what people don't realize is, let's say they're charging 200 basis points or 150 basis points for a mutual fund, which is pretty normal. That, let's say you're investing $5,000 a year. That is literally probably a couple $100,000, maybe more, depending on how long you do it for, out of your pocket when you're 65 or 70 years old. So my point there is, could you learn the basics of investing if I were to pay you $250,000 to do it? And probably 95% of the people, if that's the way you frame it, they could do it. So that's the first point I would make. But when it comes to actually investing, volatility is not necessarily a bad thing. The best performing assets, especially in their early stages, are very volatile. You look at Bitcoin, you look at Nvidia, look at the Nasdaq versus the S&P. They're all more volatile than the benchmark, and they're the best performing. Now, again, something that is wrong that some people will assume here is that they'll assume something is volatile, therefore it's a good investment. That is not true. You have to make sure the fundamentals line up. But if the fundamentals line up, who cares about volatility? Like, I have never once, well, especially recently, but maybe when I was first getting into things, but recently I've never once, when I was looking into investing in a stock or anything, considered, is it too volatile? Like, that's never something that has crossed my mind. The only thing that crosses my mind is, when it comes to stocks, are the fundamentals good, and is it a good price based on valuation? That is the only thing that crosses my mind. Now, again, there's a lot of details that go into that, and that's something for a different video. Volatility is not something that crosses my mind. When it comes to Bitcoin, this is something that a lot of people constantly bring up. Volatility is completely irrelevant when it comes to Bitcoin, number one, because other cryptos are more volatile. And number two, why is volatility a bad thing? When it comes to performance of an asset over time, volatility is irrelevant in my mind. Now, again, some people would come back and say, the risk-adjusted return of this versus that. And it's like, okay, maybe you can come into that. But when you're in your 20s or 30s, which is probably the vast majority of people watching this, who cares? Like, seriously, who cares about volatility? Now, again, I am not a channel or the kind of investor that exists to trade. If you are a trader, yeah, you need to have a different mindset. But if you are a buy and hold long-term investor, who cares? In fact, I would argue volatility is a good thing because it simply provides good buying opportunities. And not only that, the weak hands or the below average investors are going to be scared off. And you don't want those people to be invested because those are the kinds of people that are going to dump the minute that anything the slightest bit wrong goes wrong. So that's what I wanted to bring up here today, essentially. That stop thinking that volatility is a bad thing. Sometimes it certainly is. I'm not saying that. But when it comes to the best performing assets, they are going to be the most volatile. That's just the way that it goes. And the reason for that is for assets to perform extremely well, they can't have everybody and their dog holding it because then they won't be volatile. The reason they're volatile is because most people will not invest. And on top of that, if the average person does invest, they're constantly panicking and getting in and out of the fund. I remember reading a story about Ray Dalio's fund that I believe has been one of, if not the best performing funds. I think he beat the S&P like 25 years in a row or something like that, which is crazy. And what they found was the average hold time on the fund was extremely short. And not only that, only a very, very small, not nearly as many people that invested in the fund made money as you would think. You would hear best performing fund of all time and think, oh my God, like 90% of people must have made money, but it wasn't. It was like 55 or something really low because people couldn't stand the volatility. So when it comes to investing, a lot of people say, oh, well, what kind of stocks are you buying or what do you look for or that? And I would argue one of the most important, if not the most important trait of a good investor is the ability to deal with volatility. And that's why being invested in, even though it's not really that much in the whole scheme of things, but being invested in Bitcoin and very small amount of other cryptos has done so well, because I see a stock drop 5 or 10% and I'm like, that is peanuts. Like, that is absolute child's play. Like, who cares? And the last thing I'll touch on here is volatility oftentimes simply provides good buying opportunities. And this is something that the experts do. This is why you're traditionally recommended to hold 10%, or some people say as high as 20%, other people as low as 5%. Doesn't matter. This is why professionals always will recommend holding a certain percentage of cash, because if you get a steep drop off in the market or in a particular stock that you like, that will give you ample opportunity to buy in. Because if you're 100% invested and you have a big sell-off in a stock you really like, and the sell-off is for no particular good reason, you're screwed, because you're going to have to sell something or you're not going to be able to buy. So that's why, again, another reason why volatility is a good thing, at least when it comes to good quality companies. So that's something that I wanted to bring up, in that if you want to get invested, if you want to start investing, if you're new or whatever, you name it, learn to deal with volatility. Volatility is normal. Just make sure you're investing in quality companies. If you're investing in quality companies and the price goes down, you should like it even more. And that's another good question that I'll leave it on here is, when you're thinking about buying a company, one of the questions you should be asking yourself is, if this company went down 10, 20%, and let's say nothing fundamental changed about the company, it's a one-off event, it's going to be fine long term, would you like it even more than you currently like it? And if the answer to that is no, you probably shouldn't be buying. And again, that is a very, very important question that you should be asking. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.